All right, let's get started. I'm Marc. I'm from 51. We're a research and market intelligence company for digital assets. We equip digital asset companies, corporates, technology leaders with insights and market intelligence they need to lead. Today, I'm excited for this panel. Stablecoins have exploded in 2025. We all know that. They reached a market cap of over $250 billion. By now, more volume than Visa Mastercard together per year. Fortune 500 giants are starting to build with stablecoins. Fintechs are starting to build on stablecoins. Payment companies are entering the space. Stripe launched their own stablecoin, PayPal, and the whole space is literally exploding. But how do we go from hype to infrastructure, and how can businesses seize that opportunity? That's what we're discussing today, and that's also what we're publishing in our upcoming report. For those of you who joined, you will receive that after the webinar. So I'm super excited to have two leading founders of that space today here. First is David Stewart. He's the CEO of OpenTrade, a powerful stablecoin treasury and yield product company. David, I'll give you the word later, but I know that you've been in Bitcoin and blockchain for a long, long time. You're a veteran. And then on the other side, we have Tony McLaughlin, CEO of Ubix, the first stablecoin clearinghouse. And Tony is the opposite. He's a banking and payments veteran with 20 years at Citibank. And today he calls himself a stablecoin maximalist. Welcome, both of you.
Hey, it's great to be here, Marc. So I'm Dave. I have been working in crypto and on stablecoins and tokenization since I was a college student, which is increasingly becoming a long time ago. Most recently was working on USDC through a joint venture between Coinbase and Circle called Center, which founded and governed USDC. And over the past decade, working with fintechs and large financial institutions on stablecoins and tokenization. With my co-founder, Jeff, we're inspired to launch OpenTrade, which is a infrastructure provider for stablecoin yield. So we work with fintechs around the world and power their stablecoin yield products.
Cool. Thank you, David. And Tony?
Yeah, great to be here. Nice to meet you too, David. Keen to hear about your experience in Center and other things. So yeah, I come from a slightly different background, 30 years working in payments, and quit my career in TradFi because I became convinced that tokens on public networks are the general purpose technology that will take over from the special purpose payments rails that we've been working with forever. So I deliberately call myself a stablecoin maximalist because I see that as becoming the dominant form factor of payments on the planet.
I'm sure we're going to dive deeper into that thesis as well with you, Tony, later. The first thing I would want to talk about is, why is stablecoin infrastructure exploding right now? And maybe starting with you, David. You've been in this space for nearly a decade or longer, actually. What is different today than it was different 5, 10, or 15 years ago?
Yeah, I think today what you're seeing is basically the culmination of a lot of time and effort that's been put into making this a reality by a lot of different people and businesses. It's definitely hasn't come from nowhere, right? We started seeing some of the first examples with putting real world assets on blockchains. I was part of that using the Bitcoin blockchain when there were no other networks other than Bitcoin. And then basically an extended decade of work to make that vision a reality. We had if we kind of look at the history of stablecoins, right? They kind of were started as a way for crypto exchanges to provide a representation of a dollar as a trading pair because they were locked out of the banking system, right? That's like what the initial impetus for stablecoins was. We then kind of fast forward to DeFi summer, where we had an explosion of really speculative activity in crypto and in DeFi, where stablecoins became a huge piece by trading volume of the overall crypto economy. And basically throughout that period of time, you had market makers and liquidity getting built up. You had wallets and wallet infrastructure providers getting built up. You had on and off ramp providers getting built up. You had the stablecoin issuers themselves, preparing themselves to scale and expanding their operations globally. And then that basically met what has become real world demand outside of the crypto economy, which are primarily today being driven by people who want a better, smarter, faster, flatter dollar. whether they're in emerging markets as a way to escape, hyperinflation and currency controls, or whether they're Fortune 500 businesses who, process, millions of payments a year and want a faster and cheaper, smarter way to do that. That's all that infrastructure that's been built up in the crypto context was required to actually take stablecoins mainstream. And so that it's not, to me, it's not a surprise. It hasn't come out of nowhere. But then I think also the political environment that we're in right now, there's been a lot of eyes and attention through the mainstream media been put on stablecoins as well because of, crypto and stablecoins becoming a very political thing, especially in the United States over the last 4 or 5 years, has brought even more eyeballs onto it. So that's why I think now is the case.
And Tony, how did you observe that from the outside? Well, while you were still at Citibank, you obviously saw that development. You saw stablecoins emerging. How did you think about this from your Citibank perspective?
Yeah, well, look, I watched, again, if you're sitting in a bank, you watch the rise of crypto and original Bitcoin, and you ask yourself, is this going to become a medium of exchange? And it didn't, for reasons that I think we can understand. And, I think we have to accept that, at this point in time, Bitcoin didn't become the peer-to-peer payment instrument that it was set out to be. And then central banks were not that bothered about it either. They were keeping an eye on it. It wasn't really challenging sovereign currencies. And then came along Libra. And for the first time, the central banks and the banks got really concerned that there could be a novel form of money, which was originally it was non-sovereign currency unit. It wasn't pegged one-to-one with the dollar, that could achieve hyperscale. And that very quickly led into the counter reaction of central bank digital currency. So all of this stuff really became super interesting from a bank perspective in 2019 with the development of Libra. And that started my work on private permissioned blockchains, because at that point in time, the design space for a bank was limited to private permission chains. And look, all of the stuff that David mentioned is true. All of the builders were building. But to me, the catalyst, frankly, for jumping into the stablecoin space was the US election. Because post the US election, this is the critical thing for me. It became clear to me that banks and fintechs would be allowed to use public infrastructure. And that for me was the catalyst.
Did you think about this the same, David? Did the recent regulation of the Genius Act and the opening up of the US to crypto change your thinking or trajectory?
It didn't change my thinking or trajectory, but that's me. What Tony said is absolutely true for a lot of people, right? Because, looking at Circle, right? Let's look at USDC. They've basically been doing everything that has been now enshrined in the Genius Act, right? They in many ways help write the Genius Act, right? They spent a lot of time in Washington with regulators and lawmakers, educating them, and did a lot of important work for everyone in this industry. But still, there was that question mark of, especially what we saw in the prior administration with the sort of stance that they took when it came to enforcement, even with stablecoin issuers, like shutting down BUSD, right? There was still an open question mark of like, how is the American political landscape going to define the outlook for stablecoins and any company building on or with or in stablecoins? Whether you're an investor, like trying to allocate capital to a business, or whether you're going to be a user, or really anyone, had this sort of uncertainty. And so what has happened now with the Genius Act is that that's gone away, right? So there are now clear rules of the road, so to speak. And now if you're looking at a business plan that's building 5 or 10 years for the future, that question mark of, will these things be illegal? Or will they continue to sort of be in this gray zone? Or will they actually become sort of endorsed by, the Federal Reserve or the OCC? Those questions are gone now, right? And so now it's very much a question of use case, adoption, go to market, sort of the commercial model of a stable coin and what it can do for people. It's no longer a question of, is this going to become illegal or get killed? And so what Tony said is, it wasn't for me personally. I'm more of I've been red pilled, so to speak, since I was in uni, but for the vast majority of people, and that's important for all of us.
If you look at the stablecoin landscape now, David, you're building a treasury yield product. Tony, you're building the first clearinghouse for stablecoins. outside of that, where do you see the biggest opportunities for businesses and enterprises and banks right now in stablecoins?
So, Mark, I have to say that I hate the use case question, because when you're dealing with a general purpose technology, if someone asks me what's the use case for a laptop, it's the kind of like the wrong question. But since everyone's interested in use cases, I'll just give you a really, really, really big one. I actually think the answer is every type of payment on the planet in due course. But since people want to make things concrete, let us think of all of this stuff that Americans buy on marketplaces, hundreds and hundreds of billions of dollars of sales every year bought on marketplaces. Where is that stuff made? It's made in Asia Pacific. Now, just imagine that one of those marketplaces has the bright idea to launch a stablecoin, either by itself or in partnership with someone else, and pays those suppliers in their own stablecoin. Would that be a smart thing to do or a dumb thing to do? It'd be a very, very smart thing to do for that marketplace. And so the first of those marketplaces that do that transaction have the potential to be the biggest stablecoin on the planet within 18 months. So you want a big use case? There you go. But my real answer is stablecoins are general purpose technology, and they will take over every use case.
That's a great, I love that answer, Tony. I think for me, I think the most exciting use case is stablecoins as a global dollar account for anyone with an internet connection. So let's take ourselves out of the shoes sitting in a advanced Western democracy with a stable banking system and a stable monetary and fiscal system. And let's transport ourselves down into a country like most of the world that doesn't have that, right? Where people and businesses have a real dire need to save and spend and send and receive something like the US dollar, actually the US dollar in particular. And before stablecoins, that was a very hard thing to do, in many cases impossible. So you had all these sort of physical black market sort of currency exchanges around the world that were doing this unofficially, and very much in a non-technology enabled way. What stablecoins have done is give anyone with an internet connection the ability to receive, send, store, save, and earn returns in dollars, and do that on a mobile phone, and do that in a way that really reduces, or in some cases eliminates, the need to depend on intermediaries or sort of, in many cases, a corrupt banking system. So I think that's an extremely powerful capability. And so on the back of that, you've seen consumer remittances, sort of neobanks, payment services providers using stablecoins as a way to, in the same way that we saw in Africa, sort of them leap over landlines and go straight to cell when it came to mobile communications. We're seeing a lot of emerging markets like leap over the traditional dollar banking sort of correspondent banking system and go straight to stablecoins when it comes to building dollar first financial services in the markets, and for the people that want and need those dollars for reasons that are much greater than, trading crypto. And so for me, that's the most exciting use case. And you're seeing in Nigeria or in Turkey or in Argentina or in Colombia, massive adoption amongst regular everyday people and businesses of stablecoins as a means of sheltering themselves from currency volatility, as a means of becoming connected to a global financial system, as a means of more efficiently transacting with either buyers or suppliers across borders. So I think that for me is definitely the most exciting and the biggest unlock of stablecoins.
Yeah, so it's super exciting, and I think we heard it from Tony, and we hear it over and over again. It's a plethora of use cases. It's across the board. It touches everything, and that's what it makes it so exciting. So let's start with you, David, with OpenTrade. Can you explain a little bit better, what is OpenTrade? What do you do? What is yield as a service, and how does that all work?
Yeah, absolutely. I'll kind of spare you the technical jargon, actually, and just give you a very tangible example. If you're a individual or small business, let's say in Colombia, and you want to spend, send, save, and receive dollars, you will today sign up for a neobank like one of our partners, Lydia, and they'll give you the ability to take your local concern and convert it into a dollar or euro balance. And then you can spend on a card, you can send money, you can receive money. And interestingly enough, you can now invest money and earn returns on those dollar and euro balances. that part where you're earning returns on those dollar and euro balances is what we do. And so we provide a technology platform, a legal framework, all of the off-chain banking and custody infrastructure and the on-off ramps that allows a fintech building on stablecoins, providing stablecoin powered financial services to earn yield and pay yield on dollar and euro balances with a single API integration. And so that end user, what they're able to do is with one click, start earning interest on their dollars, and with one click, withdraw that and get back into a local currency. That's what OpenTrade enables. And there's a lot of technology and operational capabilities and legal frameworks that enable that, but ultimately the core use case is that. And it's this very simple user experience. And so we partner with fintechs that are providing these financial services and power their yield generating products.
And how does that yield compare to traditional money market funds?
Yeah, today we offer a wide variety of products from money market funds and sovereign bonds to corporate bonds, high yield bonds, private credit, fixed income, trade finance. So we give a lot of different options, and soon, DeFi native and crypto native yield strategies. In terms of how it compares, so in many cases, they don't have access to these things at all, right? So in many cases, it's a 0 to 1 step change. It wasn't possible before, and now it is, right? Where it is possible, it's faster. It settles instantly. It's cheaper. It's nearly free. It's 24/7 by 365. There's no banking hours. It doesn't close. There's no branches. It runs all the time. And it's entirely programmable. So you have any type of complex workflow you need to integrate and reconcile across front, middle, back office systems, event-based payments, event-based settlement, event-based investments or withdrawals. All of this is completely composable. And the last thing I'd say is it's now one of the great things about the proliferation of crypto broadly and stablecoins within that is that we have these wonderful standards that everyone adheres to, where anyone with a wallet that accepts an ERC20, which is every wallet, or anyone that uses Wallet Connect as an example. I mean, there's a huge example of these standards. It's very easy to integrate and adopt using sort of these now new composable sort of Web3 native standards. And so all those things are much better than what you experience with legacy. I mean, we have one customer who the only way that they were able to do this was via fax. And they had a broker that was charging them 1% to 2% a trade to buy a money market fund. This was a customer in Latin America. And so now, I mean, it's just, that's not a 0 to 1, but that's like a 1 to 10 sort of improvement that they've.
And David, follow-up question. When you talk to customers, is this still kind of a DeFi crypto native mindset that they have, or is this a real pain point felt by treasurers? And how do those conversations usually develop and go?
It's a real pain point felt by treasurers. So in terms of our clients, we do have Web3 native customers, exchanges, staking providers, custodians. We also have what we call Web 2.5, these are companies providing traditional financial services to mainstream users, but using stablecoins to do that. And so your question is more for the latter type sort of persona. And for them, I mean, you don't have to convince them of the need, right? They already have this need. This is something that has existed before crypto and stable coins. And so really it's a pretty natural conversation where the focus is not on whether it's a decentralized public ledger or whether it uses a smart contract. The conversation is very much focused on, how quick does it work? What are the fees? What do I have access to? How can I integrate it? And those things are all very positive when they kind of get the feedback on what it can enable. And I think that's ultimately what we've all been trying to do working on crypto and stable coins, is make the conversation much more about what value is the end user getting out of it, as opposed to, hey, we're just using this because for the sake of it being this type of technology.
Yeah, exactly. Then Tony, let's talk a little bit more about Ubix. You said you're the first stablecoin clearinghouse. Something you've talked about a lot is money that moves at the speed of software. Can you unpack that a little bit from the clearing and settlement perspective?
Sure. The mission of our company is stablecoin ubiquity, and our contribution to that will be to enable anyone to receive stablecoins into their existing bank or fintech and deposit them into their existing account. So we're not going to replace existing off-ramps. If someone wants to go through an exchange, that's great. But what we will do is add a new lane to the highway. And the reason why that is going to happen is because of foreign exchange. So one little secret about banks and fintechs, their favorite way of making money is foreign exchange. And the supply of stablecoins, and it's not, by the way, this story is not just about US dollar stablecoins, but let's start with US dollar stablecoins. So if we imagine a supply of US dollar stablecoins of $1 trillion, and all of those dollar stablecoins travel into the world, it generates a potential revenue of fees and FX of, and you can find the math, not even math, it's arithmetic, it's in my white paper, but it generates an annual revenue of fees and FX of about $40 billion. Whomsoever catches those dollar stablecoins and converts them to local currency. And you better believe that the whole world is going to gear up to catch American stablecoins and convert them to local currency. And the proof point of that you'll find in history. Now, you guys are pretty young, but back in the day, your parents were traveling around the world with dollar travelers checks. And everywhere in the world accepted dollar travelers checks. Every bank, every bureau de change, every large hotel accepted dollar travelers checks. And the reason is when your parents walked into that bank, the bank made FX and fees by converting the dollar travelers check into local currency. The stablecoin game is the same dynamic times 1,000. And you better believe that every bank and fintech on the planet is going to gear up to accept and convert stablecoins because they love FX. Now then, if you imagine a Japanese bank that receives many different stablecoins, and by the way, this idea that there's going to be an oligopoly in stablecoins is wrong, flat wrong. There'll be many, many issuers of stablecoins because there's too much money to be made. With that same $1 trillion of issuance, if rates are 4%, then the issuers make $40 billion. So there's going to be massive competition on the issuer side. So many, many issuers, many, many receivers, you get many-to-many network. And a many-to-many network cannot be resolved bilaterally because the number of connections is A times B. When there's a clearinghouse in the middle, the number of connections is A plus B. And so we will provide that connection in the middle, and a range of wonderful benefits will arise from that clearinghouse existing. Number one, from the issuer perspective, is there will be a common acceptance network. The current market structure where issuers have to build their own distribution is wrong. And secondly, on that type of a network, you can generate very substantial non-interest income for issuers. So think about this. In today's world, issuers pay for distribution. In the cards world, distribution pays the issuer. That's called interchange. So the stablecoin market structure cannot survive with the existing modus operandi, where every issuer has to build their own distribution and the issuers are 100% dependent upon interest rates. That's not healthy market structure. Healthy market structure is common acceptance network and non-interest income for issuers, and that's what we will bring about. And that will lead to ubiquity. And the market structure for stablecoins is pluralistic. It's multi-currency, many issuers, it's many receivers. If you understand the history of previous waves of technological evolution in payments, this happened in checks, it happened in cards, it will happen in stablecoins.
And how do you look on recent developments that now stablecoin issuers like Circle are starting their own blockchain and banks are launching their own stablecoins? Does that validate your thesis that we will live in a multi-stablecoin, multi-chain world, and there's
so Mark, let me give you the comparison. So there are 16,000 card issuers on the planet, and customers of any one of those issuers can walk into Bloomingdale's and spend money, and Bloomingdale's does not care about the issuer. Now, what has to be true? What has to be true is that the smallest issuer of a card on the planet can only issue a card if they don't have to build their own distribution network. And that's what exists. So there will be thousands of issuers of stable coins and tokenized deposits. Stable coins haven't invented fire. Stable coins are a negotiable instrument they've been around, which have been around in paper form for hundreds of years. Negotiable instruments are not new. What's new is that they're being instantiated on general purpose technology. And that general purpose technology is far superior to paper. But the patterns that you get of negotiable instruments are the same through history. And I would even argue they're the same on other planets. So the way in which the stablecoin market will resolve itself, I don't mind making predictions. It will be pluralistic. It will be multi-currency. It will be hundreds or thousands of issuers. And also the winners of the game have not even entered the arena. They haven't even shown up yet.
Let's take a step back, Tony. I think that's really interesting. And think about what would this mean for a business or a fintech wanting to build with stablecoin? Does that mean they now need to start issuing their own stablecoin? Do they need to build on existing stablecoins? How does this change the thinking for a business leader?
Well, how it should change the thinking for a lot of banks and fintechs is, for some reason, they think the stablecoin strategy begins with issuing. For most people, the stablecoin strategy should begin with accepting. Because if you're a bank outside the US or a fintech outside the US, you can begin making FX tomorrow by accepting stablecoins. So for most people to begin with, usually they say it's better to give than to receive. In the case of stablecoins, it's better to receive than to issue to begin with. But once everyone can receive, then anyone can issue.
What is your take on this, David?
I think Tony brings up a lot of really interesting points about the sort of fundamental infrastructure of the stablecoin markets. I think, in my experience, the end users, the fintechs aren't, to be completely honest, thinking as deeply as Tony is about what their place is in sort of the historical arc of stablecoins and what role they should play in the overall sort of market structure of stablecoins, which is nascent. And with that said, what Tony points out about the point about, first port of call being focusing on accepting stablecoins, I totally agree with that. I mean, I think to your earlier point about Circle sort of building their own blockchain and some of the activity you've seen Tether undertake, whether it's investing in Bitcoin mines or buying, agricultural conglomerates in Latin America, or I think everyone has a realization that the issuer business model being a net interest margin that's tied entirely to the risk-free rate, which is governed by monetary policy in the U.S., is a very tenuous position to be in, right? Because then your revenue is entirely outside of your control, essentially. And so all of the issuers are starting to focus on where can they, what other value-added services can they provide that open up new revenue streams that are not as correlated to interest rates as their current ones. And certainly for stablecoins to become ubiquitous, there needs to be a broad network of on-off ramp providers. And whether that's an off ramp into a dollar in a bank account or that's an off ramp into a local currency, that is an absolute necessity. So, I mean, I think my thoughts are agree with, and I think Tony's thought very deeply about this, agree generally with what he's saying. And but at the end of the day, to the end user, the sort of boots on the ground, the people at the coalface, whatever analogy you want to use, they're very much thinking much more short term about this. What can you do for me today, and what can you do for me now, and what's the reason I have to use this? And that's kind of more of where we focus, which is not a bad thing. I mean, I think there needs to be people thinking about looking top down and people looking bottom up.
Exactly. That's something I just wanted to bring up, David, whether that's at all part of your discussions when you talk to clients.
I mean, look, today, to be honest, it's USDC and USDT. The network, I mean, we do a ton of work with Avalanche. They're fantastic. We love Avalanche. We build on Avalanche. It's a very fast, cheap, secure chain, and we're seeing a lot of adoption. But even the network discussion is somewhat, it's USDC, USDT, which network are we on? And then it gets really into the details of the product, because that's ultimately, to Tony's point about ubiquity, those are the closest stable coins to ubiquity. And so we've actually seen a lot of issuers really struggle to reach anywhere to take market share from USDC and USDT because they've got the early inklings of network effects, and they are, in the small world that we live in today, even though it's exploding, it is still relatively small when you look at global payments as a whole. They are ubiquitous within the stablecoin economy, right? It probably, I don't know the current statistic, 98% of stablecoin market cap and 98% of stablecoin by transaction volume is in those two. But look, I know people, the thoughts that and the mission that Tony's on is very important. Because if we believe in a world where stablecoin, we can't have sort of a million different stablecoins and no interoperability and no ubiquity and no sort of fungibility across them. Then we've just recreated a bunch of problems that we tried to solve, which is we now have all these little digital monetary islands that don't talk well to one another. And that's certainly what no one wants to do that. And so I think the thing that's great about the stablecoin ecosystem is you've got a really great group of very smart people and great companies all focused on sort of the overall picture. Everyone's working in their own little corner, but it's creating a very nice ecosystem.
Yeah. Thank you, Dave. Thank you, Tony. We're already 40 minutes in, and I would like to switch to our Q&A session. The questions that I want to start with is, why aren't card networks like Visa, Mastercard, Amex best positioned to provide an acceptance infrastructure rather than a startup?
Well, look, you have to be, if you're a company take a look at the market cap of these companies and ask yourself whether they're going to be prepared to disintermediate themselves. I don't think so. At the moment, there's this trend of putting cards, high interchange. So these cards on the front end of stablecoins are some of the highest interchange cards that exist. I don't think this is cool. The stablecoin, if the stablecoin just becomes a feeder into cards, we've failed. So we need to make stablecoins natively accepted everywhere cards are accepted and give them a run for their money, including at the point of sale. So at the point of sale, you should not need to associate a card with a stablecoin balance in order to pay at the point of sale. If we three go out for a steak and we pay the restaurant with a card, we actually walk out of the restaurant without having paid. The only thing that the restaurant has received is an authorization. They get paid 2 days later. If we can pay the restaurant with a stablecoin native, by the time we walk out, they have been paid. So our job is not to feed into the cards networks. Our job is to provide an alternative. So I'd like to see stablecoin native payments. And I don't think the cards networks are going to fall over themselves to bring about that future. Quite the opposite.
Yeah, I think just to add on to that, to the question, I think Tony's exactly right. But theoretically, they are the best positioned. Like if they didn't have self-interest in mind, then they are like the networks that they have, the distribution that they have, the ubiquity that they are the best position. But the point Tony makes about it's actually sort of not in their self-interest because they make money hand over fist, charging 1.5% or 3% anytime someone swipes a card anywhere in the world. That's a golden goose that they're not going to walk away from, right? And so there's going to need to be alternatives and challengers. And so it has been interesting to see how these card providers have sort of dabbled their toes. It's almost like know your enemy, right? So they're like, they're dipping their toe in the stable coin, and there's some press releases, and Visa has a great research team that works on it. But I think there's probably tension even internally at those organizations about how to do this. I would actually be surprised if there's not some dissenting opinions within those organizations about what stable coins mean for them and what they should do for it. There's probably a little bit of a Blockbuster Netflix kind of thing going on, right? Where this is the future. Some people believe it's the future, like Tony or I do, and let's disintermediate ourselves before someone does it for us, kind of thing. Like Blockbuster famously had the chance to acquire Netflix and didn't do it, and we all see how that turned out. I do miss Blockbuster though, very nostalgic for me. But they are, just to conclude, they are theoretically the best position, but there's strong sort of incentives for them not to do it in the most narrow sense of the word.
And then we have a question for David, OpenTrade. When enabling yield sharing of stablecoins on OpenTrade for fintechs, does this start getting into potentially security considerations, and how do you navigate this? Is yield getting distributed from the underlying stablecoin or from supported vaults?
Yeah, so we actually believe pretty strongly in the separation of church and state, where you have stablecoins and stablecoin issuers, and these are used for payments. And then you have products that help generate yield on those, whether that's lending or investment products or a mix of both, like we offer through OpenTrade. It's important to sort of have those things be separated, right? And so we provide yield products for USDC and USDT, but the issuers USDC and USDT aren't paying yield natively. And so in the simplest sense, people invest stablecoins through our platform. They're converted or deployed into some type of yield generating strategy. And then there's an on-chain protocol that ties the interest accrued in that strategy to the balance of the end user and to the fintech. And then when there's a withdrawal, the reverse happens. That position is liquidated, and the stable coins are either repaid or on-ramped from dollars and then repaid. So there's a clear separation of church and state. We have the issuers, and then we have service providers like OpenTrade. And the regulators have been pretty clear that they want to see that separation in terms of market infrastructure. Like they explicitly, in the case of the UK and the EU and the US, have said stablecoin issuers shouldn't pay interest on those stablecoins. If they did, it would only ever be the risk-free rate, right? It's not a good idea to build a stablecoin on, risk. Well, commercial banks do this with commercial bank deposits. They do build stable values of things backed by illiquid, risky loans, but the government has given them the license to do that, right? They haven't given stablecoin the issuers the license to do that.
Thank you, David. Then we have another question. If issuers can't pay yield or interest on payment stablecoins, the only differentiation is issuer risk and adoption. What does proliferation of many stablecoins solve? To the contrary, won't it only muddy the waters, opening it up for fraudulent coins?
Look, I actually had this discussion. I'll just say one thing really quickly, which is like banks don't really pay interest either. I had this debate with, like, they do pay interest, but like who's like in the United States, like you're earning 0.01% on your checking account. I just opened a new checking account, Bank of America, and I'm getting nothing, right? And so the idea that there's like this big divide between what bank deposits pay and what stablecoins, but it's for most people, it's actually not there. But anyways, Tony, go ahead.
Yeah. No, look, I was going to make the point that, again, get to grips with the fact that there are 16,000 card issuers on the planet and ask yourselves how they compete. And then you'll get an inkling. So if you're a stablecoin issuer today and you think you're the boss, you better war game the following scenario. You better anticipate. Now, I've got no idea whether these companies are going to do it, but you better anticipate that there's going to be an American Express stablecoin or a Capital One stablecoin that will come with their brand and points and credit. And then, Mark, if I'm making you a payment and I've got a choice between sending a pre-funded instrument or sending you an instrument which I can get against the line of credit, which am I going to prefer? And if you're just a normal guy, Mark, and you've got a choice to receive a stable, something which is from a stable coin issuer or something which is from one of these big brands, who are you going to prefer to receive? So this is what I mean. If we're such in the early days that back in the day there was something called America Online. It doesn't matter how closely you stare at America Online, you don't see the internet. Now, what we're doing in today's world is everyone is staring so hard at the current players and the current market structure and extrapolating forward from that they cannot see that what we have today is not a reflection of what we're going to have tomorrow. Big things are going to change. The issuers are going to change. The winners are going to change. There will be tokenized deposits and there will be stable coins. They'll both find their own natural purpose. So there's going to be many issuers. If anyone wants to put a bet against that, then hook me up and we'll revise it in 3 years' time.
Last question from my side is, what would you advise business leaders that want to build on stable coins? Is there a tip, an advice that you would give them? How should they approach this topic? Should they think about it?
I can go first because I think Tony will have a much more meta comment than mine. So he can leave you with the very strategic sort of long view. I would just say, go use them. Actually, I think one of the things that people miss in a lot of the discussions around this stuff is they've never actually used it. Whether they have an opinion on DeFi or crypto, or in this case, stable coins, use it, right? Like sign up for a Coinbase account, buy some USDC. I mean, sign up for anyone. This isn't a Coinbase endorsement. That's what I use. But pick your own exchange. Coinbase is great. And move some money around. Go to Aave. Deposit some funds, right? Move money between two wallets. You will see, I think what you'll experience, if you have any experience moving dollars, you'll see that it's pretty easy. And you'll start to understand why it's such a powerful thing. I remember when one of the first things I did at Center was build for the company an app using Circle's API. I did it in Postman in 4 hours. I could send wires to 180 countries, right? You know how long that would take with like traditional, like if I was dealing with a bank and like integrating to a core banking system. And like, you know, even as a startup, like we receive wires from investors, we pay out wires to pay customers, and it's always a nightmare. So just like very tangibly, go use them and form your own opinions. You may, hey, you'll see the UX is still a little rough, right? You probably aren't going to want to have to worry. Wallet addresses are going to be a new thing to you. The idea that if you send it to the wrong thing, it's going to get lost forever. These are all issues that are being overcome, right? But go use them. That's my advice.
All right. Thank you, David and Tony.
Yeah, David is right. You know what? I'll tell you something really interesting. None of the people who are regulating stablecoins have ever seen a stablecoin.
That's a good point.
Because they're not allowed to hold crypto wallets or hold crypto assets. When you see leaders from large financial institutions on TV saying they're going to launch a stablecoin, they've never seen a stablecoin. So David is completely right. But since David asked me or gave me the challenge to say something more meta and strategic, I'll say this. The age of accounts is coming to an end because a bank account is a one-trick pony. The only thing your bank does, like Mark, if I ask you how much money have you got, you probably think, okay, how much money have I got in my checking account? Your checking account only does one thing. It contains dollars, which is a liability of your bank. So it only does one thing. A wallet can contain the liabilities of many banks and stablecoins from many issuers and tokenized money market funds and tokenize other real world assets. Take your pick. So what's really happening is that, again, it's the form factor of tokens on public chains and wallets, which is far superior to a bank account. So if you are listening to this and you are a bank or a fintech, your whole business is built upon accounts in the same way that the whole Blockbuster business was built upon magnetic tape. Now, if you want to stay in business through this change, here's something you must do. You must offer every one of your clients a wallet. You must, because the age of accounts is coming to an end and the age of wallets is beginning. So if you want to be relevant, offer your customer a wallet. That's my advice.
Thank you, Tony. That was a great ending word. Thank you, everyone who joined on Zoom and all these other channels. If you signed up for the webinar, you will receive a report that we published together with Avalanche. Avalanche is a proud partner of this webinar as well. And stay tuned. I wish you all the best, David, with OpenTrade and Tony with Ubix, and enjoy the rest of the week. And thanks, everyone, for joining. Talk soon.
Thanks, Mark. Thanks, Tony.
Thanks.